Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And it is time for episode 45 of my stock picks of the month monthly series video, where I will give you an overview or to really give you an update on the lay of the land when it comes to the high yield income oriented funds that this channel focuses on both the Canadian and the American stock market, the US stock market. So by the way, if you're American, you're watching this, you care nothing for the Canadian stock market, use the YouTube chapters below to skip to the US stock market part. So in case you didn't know, my name is Adrian. If you're a returning member, obviously you know that this channel is all about high yield income oriented investing. So this channel focuses really on the high yield funds that use options, especially things like covered calls, things like leverage, sometimes both, to really enhance the yield, to get you some yields north of 10% plus. So this is a monthly series where I really give you a lay of the land. We'll go over Canadian market, the US market. We'll see what I feel are the top funds, and if there's any changes, if there's any news, are there any new funds, distribution increases, decreases, what's exciting coming up. So this is really kind of like to give you an update on the income world in the stock market when it comes to these specific funds. So let's get to it. Once again, use the YouTube chapters below. If you're American, you could skip over the Canadian part and we'll see what's going on in the income world as of December 2023. And we'll also see what sectors I feel are undervalued right now and which funds you could invest in to really capitalize on the weakness. So let's get to it. All right, everyone, before we continue, I'd just like to take a quick moment to thank the sponsor of this video. It's Harvest Portfolios Group, Harvest ETFs, one of my favorite Canadian covered call fund manager. And I have to congratulate them on their HPYT ETF, which is fairly new and focuses on writing covered calls on long-term US government bonds, because they just crossed 100 million in AUM very, very quickly. This ETF pretty much has only been out for like 2 months, a little over 2 months, and they're already crossed 100 million in AUM. And it's no surprise because this is the highest yielding US government long bond covered call ETF in Canada. There's about a couple of them that have come out, the 6 in total, but this one is the highest yield. They're writing covered calls up to 75 to 100% of the portfolio. You get a really, really nice yield of approximately 15%. So I'd like to thank Harvest for being a good friend of the channel. And don't forget, everyone, that they also have their all-in-one. This is the ETF that I'm personally invested in. I have over $100,000 of my own money in this one, the Harvest Diversified Monthly Income ETF, which now also includes HPYT. They added a little percentage in HPYT in this one. So now this ETF is even more diversified because what it really does is it combines all the top covered call ETFs from Harvest, and now you actually have some HPYT exposure in HDIV. So once again, thanks for Harvest for sponsoring this video. Now let's get to the market. What have the markets done in the last month? It's been pretty positive. I'm just looking at the TSX Composite Index here, which is an overall indicator of the overall Canadian stock market in the last month, the last 30 days, up 3.45%. The banks are starting to go back up. As we know, the financials, Canadian big banks make up a huge chunk of the stock market in Canada. They really move the stock market. So they've been going up, even though the earnings were a bit mixed, lackluster. TD and Bank of Nova Scotia, I think, weren't so great. But RBC had really good results. But you got to think long term. The banks have been around for 100 years plus, some of them, and they will be around once we're gone. So oil has gone down a little bit. That puts some pressure on the Canadian market, but I guess the financials offset that. When it comes to the US market, done really well in the last month, everyone. Up 4.49%, the S&P 500. The NASDAQ even a little bit higher than that at 4.53%. I mean, look at how high the NASDAQ is here, 15,840. And by the way, you could just put NDX in Google and you'll get the NASDAQ 100 index, and SPX in Google, get the S&P 500 index. So overall, pretty good last 30 days, last month for both stock markets, the Canadian and the US, which have completely different economies, right? The US is more technology, healthcare focused. Canada is really financial, more cyclical, financials, a lot of energy, a lot of material. So let's give a lay of the land. Let's go through all our favorite funds. Or the ones I feel are the most important. We'll start with, of course, the diversified ones. On the Canadian stock market, again, if you're American, just skip this part to the US stock market part. So we'll start with all our favorite diversified all-in-ones. HDIF, which I already mentioned because Harvest is a sponsor of the video. So this is Harvest all-in-one. No distribution changes. Distributions, right, Harvest is known for their extremely amazing consistency. So no raises yet on HDIV. I am cautiously optimistic they might raise it because maybe next month, maybe a tiny bit. I'm not sure. Because HTA did recently raise their distribution. They also added HPYT and Trevi in this ETF, which increased the yield. So we'll see what they decide to do. They might decide just to keep it, at the same distribution level. If I know Harvest, they want consistency, and 11% yield is nothing to scoff at. Big story this month though is HYLD. They made some big changes in HYLD, and finally I'm super happy about this, and it's also not a surprise, right? So HYLD, Hamilton, has been creating more and more yield maximizer ETF. So they recently added QMax and SMax, which is a technology one for QMax, technology stocks, and kind of like an S&P 500 or overall US equity, US stocks with SMax. That's the one I'm really excited about, SMax. So of course they're going to start swapping out some of these ETFs, some of the third party or external ETFs for some of their own in-house ones, because that will not only increase the yield of HYLD, but also lower the fees. So I'm super happy to announce that they finally kicked out QYLD and XYLD. They still have RYLD, but they kicked out QYLD and XYLD, which is the Global X, NASDAQ 100, and Global X S&P 500 covered call ETFs. These sell at the money covered calls on the whole portfolio. So this is what I feel those ETFs really have been keeping HYLD a little bit down lately. But now, as you can see, big position in SMax, also a big position in QMax, 9.4. They still have JEPI, JEPQ, QQCC, USCC. I like these ETFs a lot more because they capture upside. Hopefully RYLD gets kicked out as well, but we'll have to wait and see. I think if I know Hamilton, they'll be doing these changes gradually, and about the first or second of every month is when they update the list of ETFs here. So we'll have to wait till January 2nd or 3rd or something like that to see if there's any more changes, but I do expect more changes for HYLD, and hopefully a distribution increase as well. Hopefully we could get back to its former glory of 14 cents. Now it's at 12 cents. If I know Hamilton, they'll probably be raising them very, very slowly and gradually. So yeah, there's SMax, right? This is their first yield maximizer ETF that's really an overall, US stock market instead of really sector specific like the other ones. So the first distribution was declared here at 16 cents. You'll get about 11% yield or something like that right now because the US market has gone up. So the yield goes down, obviously. QMax also, I believe that their first distribution was declared, and it's a little bit higher than the estimated at 18 cents. And both of these, by the way, are doing at the money covered calls, but only on 30%, approximately 30% of its holdings instead of 50% like HMax and UMax. And speaking of HMax, I have to talk about it a little bit because the distributions has slightly gone down again. You see that it started at 18.5, then 17.75, 17.45. Very, very, very slight decrease. And I am in the process of talking to Hamilton to do a Q&A to talk about this, but I don't think I really need them to understand why HMax has gone under pressure because it's Canadian financials. And as we know, Hamilton ETFs is very, very responsible. They do not want to overpay, so they will reduce if they have to. And it makes sense because if HMax goes down in value, the net asset value goes down 5, 10, 15%. Obviously, they could collect less premiums with the covered calls, right? Because the premiums you collect is really based on, yes, volatility of the stocks, but also on the net asset value or the value of the portfolio. If that portfolio goes down 10, 15% like it has, like HMax has, you're going to bring in less covered call premium, which is probably why they've reduced it a little bit. So you got to expect varying distributions, everyone, with these products. UMax as well, I believe they lowered it a tiny bit because utilities have gone down as well, probably for the same reason. But again, I am looking forward to talking to Hamilton about that. HDIV, this is their other all-in-one. So, you got HYLD, covers more US. HDIV is kind of like 60% Canada, 40% US. Zero changes on this one. It's still kicking ass. As you can see, it's completely destroying the TSX 60 index, which is the overall Canadian market by a long shot, 3.75% annualized. And this number, by the way, gets updated every month at the beginning of each month. I have a strong suspicion that they will probably be kicking out HTA for QMax eventually. Why not? it's very similar exposure. Might as well get the Hamilton one and pay a lot less fees, right? So this one, no distribution cuts ever, just small increases, and we're currently at 14 cents a month. So moving on to Horizons now, they have awesome ETFs. I'm not going to cover all of them. I'm just covering, as you probably noticed, really the more diversified ones, which I feel are best for your core position. So you have USCL, which is pretty much the S&P 500 with 25% leverage and covered calls. QQCL, same thing, but on the NASDAQ 100 index, CNCL, TSX 60 index. And now you have EQCL, which I have a video coming up on it, which is basically the first, it's a game changer in my opinion. It really has everything, including USCC, CNCC, QQCC, which are the non-leveraged versions of the three we just saw, right? USCC is the non-leveraged version of USCL, QQCC, the non-leveraged version of QQCL, et cetera, et cetera. But they also have, two growth ETFs. They're not covered call. They give you some emerging markets and developed markets outside of North America. So things like Europe, Japan, Australia, things like that. So this is really like an all-in-one of all-in-ones, because you have not only sector diversification, but also regional diversification, plus 25% leverage. It's awesome. If you want, you could just have this one ETF and you're good. This would be kind of like a leveraged covered call version of XEQT or VEQT, which I'll explain in an upcoming video. So any changes? Not that I could see. For EQCL distributions, only two have come out, 19.5 cents. CNCL, it was recently reduced a tiny bit from 20.6 cents to 20 cents. So hopefully it stays at 20 cents. QQCL, two distributions, both at 25 cents, and USCL as well. A tiny bit, 23.1 cents to 23 cents. So hopefully it stays that way. But again, just like the Hamilton ETFs, guys, you got to expect varying distributions. But at least we'll probably always get distributions on like split share funds, which could vary, and either you get it or you don't, right? So it's pretty much black and white. Moving on to the other all-in-ones, you got BMAX, which is, I would say, probably one of the most steady and boring and consistent ones, boring in a good way, because it has 30% fixed income, as we know, and 70% in 7 of the Brompton covered call ETF. So that fixed income part is 20% of it is in the preferred shares, US preferred shares, and then 10% is in an ETF that I really like and I suggest for safety and a good place to park cash, the split preferred share ETF. So the preferred shares of a split share fund are very, very safe, and this ETF combines all of them on the Canadian market. So there's 10% there. So add them up, 30% fixed income, the rest in equity, but all covered call. And the distributions have not changed. It's always been 10 cents. So you're looking at a yield of about just under 10% now, right? Because the stock price is a little over $12. If you look at the chart, you'll see nice, boring consistency as well. Evolve also has two, diversified ones. Literally ESPX, their most popular one, I believe. The S&P 500. So very, very similar to USCC, USCL. This one is not leveraged. They only do covered calls on up to 33% of the portfolio, where USCC, USCL could do it up to 50% of the portfolio. So if the S&P 500 shoots up, this one will probably capture a little bit more upside. And you're looking at a yield of about 8.5%, something like that. And the distributions have not changed at 15.5 cents. They also have the TSX 60 index one, same strategy, covered calls on up to 33% of the portfolio. This one has a bit higher yield because the Canadian market hasn't been doing as well as the US market, but the distributions have not changed at 16 cents a month. BMO, last but not least, when it comes to the diversified all-in-one covered call ETFs, is BMO. ZWQT has combines a lot of the BMO covered call ETFs, and it has the lowest yield, but no, there's the least aggressive with the covered call. So if you want a really safe option, ZWQT and is a good one to consider. Make sure you check out the latest BMO Q&A video I did where we talk about ZWQT in detail. Moving on to the rest of the ETFs, you have a really nice surprise from BTCY and ETHY. Not only has Bitcoin and Ether been skyrocketing, but they've also had a nice distribution increase from 4 cents to 4.75 cents. Ethereum a little bit smaller, increase at 3.15 cents to 3.30 cents. So they both of them have really still nice high yields of in the 10-11% range. And another cool thing is that their Tesla yield share ETF has had another distribution increase. So you see it started at 30 cents and 35, now 40 cents. And this one has a yield of about 20%. So this fund is really kind of like not a watered down version of Tesla from YieldMax, but it only does covered calls on up to 50% of the portfolio. What I really love about this one is that it uses 25% leverage. So 25% leverage, covered calls on only up to 50% of the portfolio. So it's going to capture more upside than Tesla does if Tesla, the underlying stock, goes up. So just had to point that out. And by the way, their Amazon one as well. They have Amazon, they have Google, they have Berkshire, Apple. Their Amazon one as well increased the distribution a little bit, and you have about 10% yield on that one. Moving on to the closed-end funds now and split funds. EIT, no changes here, still a 10 cent a month distribution, always trading at a slight discount, which is always good to pick up. In terms of the Brompton split share funds, let's refresh the pages here. So I feel that GDV is a phenomenal pickup right now. It's only trading at a very tiny premium. DGS is trading at a discount still. It still is not paying. Still a great time to pick up DGS, guys. SBC, LBS trading at premiums. Even PWI, if you want some infrastructure, power, utilities, it is trading at a small discount. Right, because you could pick some up at about 582, but it's worth 633. But of course, remember, you got to understand how split share funds work. You could miss dividends. Either you get it or you don't based on that unit enough threshold. And if you haven't already, check out the Q&A I did with the VPs at Brompton. They were kind enough to talk about the split share funds. I know many of you were worried. Make sure to check out that Q&A I did a few weeks ago. Middle field now, you have the E-split ENS, which just did an overnight offering. The premium is fairly large on this one, about 16%, but now it's probably more like 12 or something like that. Real estate, this is look how small this premium is. This is still another one I would definitely consider. So the premium is only 5.16% on RS. So real estate still undervalued. This would be definitely a pick of the month, right? A good pickup. RS in terms of split fund. GDV, DGS would be good also. Even DFN, guys, the numbers just came out. DFN is still trading at a discount. It's worth about 464. You could pick it up for a little bit less than that, I believe. FTN, the premium is very, very small. It's about 680, 690. It's worth 652. So if you're, always a good time to pick up split funds because they're mostly trading at premiums most of the time. Now the premiums are small or even at discount. So DGS, DFN, DGS, DFN, RS, GDV, even some PWI would be really good split funds to pick up. Now, in terms of what's undervalued, guys, the banks, the financials are still undervalued. By the way, here's the BMO Q&A video I was talking about before. Here's the Brompton Q&A video I was talking about. But when it comes to the Canadian financials, Canadian banks, I'm not going to go through all the ETFs you could buy to capture the opportunity because I just recently, 4 weeks ago, came out with a video which reviews 15 Canadian banks, Canadian financial ETFs, which you should understand and know them all by heart and really pick the one that you like. Me personally, I have BKCL and Bank. Those are the two highest yielding ones, but check out this video here because that will tell you, go through all the Canadian bank ETFs, which I feel is a sector that's definitely on sale. And of course, even the US banks. I personally have Call, but there's ZWK from BMO, and there's also Hubble, which, remember, is from Harvest, and it's one ETF in HDIF already, and they're all in one, but US banks still on sale, guys. Have been going up a little bit. I think there's still much more to go. So really it's still the financials, guys, that are under the pressure, and I've talked to you about the split share funds, which I feel are good pickups. Now let's check out everything on the US market. All right, everyone, let's do the same thing on the US market. We'll check out the most popular, especially the diversified enhanced income ETFs. Of course, we're going to start with QYLD, RYLD, XYLD. So no surprises for really any of them. There never will be because it's a systematic approach, right? You're approximately going to get 1% of the NAV paid out every month. If the premium is 2% or more, in this case, you see QYLD 1.89. So they actually paid out less than 1%, 0.95%, which is why you see a little reduction from the last month, right? But that's because volatility has gone down. So more or less, you could expect 1% paid out a month if the premium is at least 2%, right? Because they give you half or a maximum of 1%. Same thing for the Russell, nothing surprising there. I think the premium was over 2%. Yeah, it was just a little over 2%, which means you will get 1%. Unfortunately, XYLD, which is the S&P 500, which is the VIX measures its volatility. The volatility has been pretty low for the last month here. So you see that they only made 1.37% premium, which means there's no way you're going to get 1%. You're going to get half of that. So you only got 0.69% of that premium paid out. Hence the big distribution drop from last month, which it could happen again, right? Again, guys, these are really easy ETFs to understand. You're more or less going to get half of the generated premium every single month, which you could see, at least they show that on their website. Moving on to JEPI and JEPQ, probably the most popular ones, right? So JEPI, new distribution came out. I was actually very surprised by this. I thought it would be lower because volatility is lower like XYLD, but no, it's at 39 cents instead of 35 cents from last month. So hey, JP Morgan, man, what could I say? They're the masters. Then, of course, you have the JEPQ, which is their NASDAQ one, went up a little bit as well also for the December payout at 42 cents. SPY is just chugging along, very, very consistent. Looks like the monthly distributions are going to be very, very similar. So SPY really is going to be the one in terms of strategy, in terms of index, very close to JEPI. I think it's outperforming it actually right now, but it's fairly close. And of course, you have the ones I'm invested in, my personal favorite ones, QQQY and JEPY, which have just recently declared their distributions. Really nice big one again for a QQQY, 93 cents. Again, guys, you're probably like the yield max going to expect slowly lowering distributions as all these big distributions get paid out and the NAV goes down. Distributions are based on volatility and the net asset value. JEPI was a lot lower. I know many of you are disappointed, and I got questions. Is there something wrong with the fund? There's nothing wrong with the fund, guys. You got to expect varying monthly distributions. Remember that distributions really plays no part in total return, right? If they want JPY, QQQY could give you 0 distributions, and it could all stay in the NAV, right? So personally, I have a big chunk in QQQY and JPY all on drip. They did come out with their Russell 2000 one, so which would be, pretty much similar to RYLD here. So exactly the same strategy, everyone, right? I'm not going to go through the strategy here. Exact same thing, but on the Russell 2000. And by the way, they've been really gaining, especially QQQY here. Look, 238 million in AUM. JPY is about to cross 100. This one is brand new, so it's only normal it's going to be less. But the first distribution came out has been absolutely monstrous. At $1.25, I do expect them to go, lower going forward like the other ones. And I do have a video queued up for the IWMI review, so stay tuned for that. I'm going to talk about it, and also I'm going to tell you if I will be investing in IWMI, yes or no. One of our personal favorites, guys, a community favorite, SFOL, and I literally just got off a Q&A with Shailesh, the portfolio manager for SVOL. We talk about SVOL in detail because, as you probably noticed, there's been this guy right here, by the way, third time back on the channel. SVOL has been growing beautifully here, very, very popular. It's been destroying everyone in terms of performance. It's been destroying JEPI, etc., stellar performance. And you see that there are some changes in the portfolio. So I do ask him about a strategy update. We'll talk all about that in an upcoming video. You have TLT. Now we'll go more to the fixed income. These are going to be the equity ones. These are more the fixed income ones. So you have TLTW, LQDW, HYGW. So government bonds, investment grade corporate bonds, and just high yield bonds. The latest distributions have all been, I think on some of them, while TLTW, it's been a lot higher than last month, which is a nice surprise. LQTW has been a lot higher as well. And I think this one, the regular corporate bonds has been a lot lower. So again, you're going to expect varying distribution rates based on the volatility of the underlying, which are, the underlying indexes or ETFs, TLT, LQD, and HYG. Moving on, I do want to add this one to the list, AGGH. I did talk to Simplify ETFs about it. And this is kind of, similar, not really similar, but I guess it's trying to compete with things like TLTW, and it's actually beating it. So it is really a bond or fixed income-oriented style of ETF, which gives you right now about 11% yield. So and I talked to Shailesh all about this ETF, so stay tuned for that one. There's also high. I have to add high also to the list of ETFs I'm going to be covering. Super, super consistent, and in my opinion, a great place to park your cash. Very simple ETF to understand. They just do short dated call or put spreads, and most of the portfolio is going to have cash and T-bills. And it's very, very, very stable. So no surprises with high as well. SVOL, I did forget to mention, or maybe I mentioned in the last few months, they did lower their distribution a little bit from 32 cents to 30. Okay, this is like 6 months ago. 32 cents to 30 cents. And I do talk to them about that. And also about why has there starting to be return of capital. So if you own SVOL, if you're curious about that, make sure to watch the upcoming Q&A video with them. Moving on, YieldMax just keeps adding on the new ETFs, everyone. So they added a new one recently on Moderna, there's Square, there's PayPal now, and then the latest one has been on I think it's an AI company. And I am in contact with Jay. He says that he's always he come back on the channel anytime. We are eagerly awaiting, of course, for their all-in-one YMAX ETF, which should be coming out soon as well. So nothing really to report on YMAX. On YieldMax. You're gonna expect varying distributions based on volatility, etc. Stay tuned. I'll try to have them on the channel again. Clip. So let's talk a little bit about Clip now. Let me just refresh here. Sorry about that, guys. Clip. So the latest distribution, let's go through it real quick, has been 67 cents. So as you could expect, you see the monthly distribution percentage here. The net asset value goes down. The distribution is going to go down as well. Of course, there are still very, very high distributions, but just like Jay talks about with these in a more recent Q&A, you gotta expect varying distributions, and if the NAV goes down, right, the distributions are going to go down. So if you don't want your value to be impacted, there's a lot of ways to play these high yield ETFs, things like YieldMax and QQQY and JPY. The most simple, straight solution is to just drip and reinvest all the distributions, but there's other ways you could do it. If you're living off the income, you could take half of it, you could invest in something else. There's a million different strategies on what you could do. So that is Clip here. Moving on to CLM. So CLM is closed-end fund that pretty much has the entire US market at 11% premium here. So decent pickup. The premium is usually a lot higher than that. I know they reset their distribution for the whole year in 2024. It's a little bit lower because the NAV was something like $7 last year when they reset it. Now it's $6.60. So it's still the same policy, 21%. And if you want an all-in-one closed-end fund solution, you have YYY ETF. Let's see what the discount is. 10.36%. Closed-end fund discount overall. So basically the portfolio, or all the 45 closed-end funds in this portfolio, if you put all the discounts together, it's about 10% discount. You also have CEFs is another one. You have HIPS is another one, in case you're looking for a closed-end fund / alternative income. But I have to say my most popular one that I feel is the best bet, not the most popular, but I think the one that's more worth it right now is still RIV, because not only is RIV itself, RIV is just a fund that holds other closed-end funds. So RIV itself is trading at about a 12% discount, and the funds inside RIV, if you open up the fact sheet and look here, is at a 12.9% discount. So you're getting pretty much like a 20% discount if you buy RIV right now. I have RIV in a retirement account and it's just dripping away, and I couldn't be happier because it's buying them at 10.69 when they're really worth 12.13. So I'll never complain about buying something that's 12% off, even more so because the portfolio inside is trading at a discount as well. So there are a bunch of new ETFs that have been coming out on the US market, and I have to say two really good ones here is GPIX or GPIX and GPIC from Goldman Sachs, and it looks like these are really going after JEPI and JEPQ. So GPIX is S&P 500 with covered calls, very, very similar to what JEPI does, almost identical. GPIC is the same thing but on the NASDAQ 100, so it would be comparable to JEPQ. One difference you could see is the management fee is the same thing, as JEPI and JEPQ. That's how you know they're going after each other. But there's actually a discount right now on these two ETFs, GPIC, the Goldman Sachs ones, at 29 basis points instead of 35 basis points. So I'll probably do a video covering these two ETFs in detail, but right off the bat, it looks like they're very, very similar to JEPI and JEPQ. The only main difference I could see is that unlike JEPI and JEPQ, they have really the entire S&P 500 and really the entire NASDAQ 100. JEPI and JEPQ does not. I go over it in a video, in a past video as well. So I'm going to keep my eye on these ones. We'll add them to the list on things to be reviewed every month. I'm telling you, I'm thinking of what am I going to do, because more and more ETFs come out and that I have to cover. So I'm just going to have to go faster, I guess, if there's any big news on any of them. But these, we're just having more and more and more choices, everyone. So it's really up to you to decide what's best for your fit, but for your portfolio, best fit. But these ETFs, in terms of these Goldman Sachs ones, they're very similar to JEPI and JEPQ and even SPY-I. We are starting to have finally, a sector-specific cover called ETF, right? There's not many. Global X has a few of them, but they're really like half-half versions. There's a financials one, and I think a healthcare one, a technology one. But this is kind of FEPI is the first really high-yielding sector-specific covered call ETF that's really high yield. That first distribution came out, it's about 25% yield. So this would be comparable, like in Canada, to something like HTA or QMAX, QQQY, the evolved one. There's a bunch of technology, TLF and ZWT. There's a million technology covered call ETFs in Canada, but now we finally have one in the US. FEPI, I'll probably do a review video for this one, but this one really concentrates on 15 stocks. So it's actually very, very similar to what QMAX does in Hamilton, by Hamilton ETF. So that's it for the overall US market. Again, stay tuned for a really good video re-explaining and reviewing SVOL, AGGH, HIGH, and even their Bitcoin Maxi ETF, which I really, really like as well. Yeah, that's it, guys. So we're going to do this again all over again next month. See you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.